Brent oil just surged 5%, and this is just the beginning. The Strait of Hormuz is effectively closed, and Goldman Sachs is calling for $120 oil by Q4. Here's the trade level you need to watch: $88.50 resistance breaks. We are going to $90 faster, so don't miss my attached trading cards before the end of this video. The Strait of Hormuz is effectively closed. Brent crude just surged over 5% in a single session, and Goldman Sachs is already projecting $120 oil by the fourth quarter. But before you jump into this market, you need to understand exactly what is driving this move and where the real opportunity lies. This is the geopolitical heartbeat of the global economy, and it's pounding hard right now. Here's my weekly verdict. I am aggressively bullish on Brent crude oil, but I want to make one thing crystal clear: this is not a standard technical rally. This is a supply shock driven by geopolitical tensions that are escalating by the hour. My invalidation level for this entire bullish thesis is a break and daily close below $85. If we lose that level, the geopolitical premium is officially evaporating and we need to reassess. But until that happens, I am looking for higher prices and I'm positioned accordingly. One thing I've learned in my years of trading energy markets is that geopolitical shocks don't follow technical rules. They follow the news. And right now, the news is screaming higher. Let's start with what matters most. Today, the news and calendar. This is one of those rare moments where the macro headlines are more important than any moving average or RSI reading. The core catalyst is the ongoing deadlock in the Strait of Hormuz. Iran has issued a strict condition: the waterway will not reopen without a complete lifting of the U.S. naval blockade and compensation. This is a critical choke point for global oil supply, and with tanker traffic virtually frozen, we are looking at real supply shortages developing in real time. This was compounded over the weekend when Iran-backed Houthi militants launched drone strikes targeting Saudi Aramco's Jazan refinery. This refinery is a key piece of Saudi infrastructure, and any disruption there sends shockwaves through the entire energy complex. U.S. President Donald Trump has stated that a massive escalation option remains on the table, so we are not just dealing with current supply issues. We are dealing with the risk of broader military escalation in the region. Today's calendar is absolutely packed with market-moving events. We have the EIA short-term energy outlook coming out, which will provide updated global demand and price forecasts. The API crude oil stock report follows, giving us the first glimpse of U.S. inventory levels. I've seen this exact scenario play out before. Back in the Persian Gulf tensions of 2020, it was these inventory reports that ultimately confirmed or denied the supply shock. If the API shows a significant drawdown, we could easily see Brent punch through $88.50 and test $90 before the end of the session. Goldman Sachs has already put out a note projecting Brent could surge to $120 by Q4 if the Strait of Hormuz disruptions continue indefinitely. This is not a fringe view. OPEC Plus has confirmed a planned 188,000 barrels per day voluntary production adjustment for September, which means supply is tightening even without the geopolitical issues. The market sentiment is heavily bullish, with geopolitical supply shocks overriding macroeconomic worries and softening global equity backdrops. Now let's dive into the technical structure. On the weekly time frame, Brent is in a strong bullish trend, extending gains for a fourth consecutive session. This is a powerful move and it tells me the momentum is real. The monthly trend is also strongly bullish, which means this isn't just a short-term spike. We are dealing with a structural shift in the supply-demand balance. The daily trend is strongly bullish with the price trading above all major moving averages. The MA5 at 85.60 is acting as dynamic support, while the MA10 at 84.30 and MA20 at 82.90 are positioned well below, providing a strong upward slope. The MA50 at 81.50 and MA100 at 80.20 are also sloping higher, confirming the broader bullish structure. On the 4-hour chart, we are seeing bullish momentum as the price overcomes near-term moving average resistance. This is critical because the 4-hour time frame often provides early signals for continuation or reversal. The 1-hour chart shows consolidation at the highs, which is actually a healthy sign. It means the market is digesting gains rather than selling off. The technical indicators are telling a clear story. The ADX14 at 28.5 indicates a strengthening trend, Anything above 25 confirms trend strength, and we are well above that. The CCI 14 at 112.4 puts us in overbought territory, which means we could see short-term pullbacks, but in a strong trend, overbought conditions can persist for extended periods. The RSI 14 at 64.2 is bullish but not yet extreme. This gives us room to run higher before reaching the 70-plus overbought zone. The stochastic 9/6 reading of 78.4 and 72.1 confirms the bullish momentum with a solid crossover. The MACD 1226 shows a bullish crossover above the signal line at 1.15, which is a strong confirmation of the upward momentum. The Williams R at -18.5 is in overbought territory, but again, in a geopolitical supply shock, technical overbought conditions can be superseded by fundamentals. When I look at this market, what stands out to me is not the headline price move itself, but the way the yield curve is reacting to the geopolitical tensions. Smart money is watching the 10-year yield reaction, and I'm seeing a pattern that reminds me of the August 2022 energy squeeze, when supply fears completely overwhelmed technical resistance levels and sent prices parabolic. So where are the key levels? The daily pivot point sits at 86.40, which is our primary reference level for the session. Above that, we have resistance at 88.50, then $90, then $93. These are all significant psychological and technical levels. Below the pivot, support sits at $85, then $83.50, and the major safety floor at $80. I want to emphasize the importance of the $85 level. This is not just a support level. It's the line that separates the geopolitical premium from the baseline supply-demand balance. If we break below 85 on a daily closing basis, the geopolitical narrative is starting to fade and we need to reconsider our entire bullish outlook. Until then, every dip to these support levels is a buying opportunity. Let me give you my exact trade setups for the next 24 hours. I'm going to share 2 scalping strategies and 1 swing strategy, all with specific entry levels, stops, and targets. Be sure to check out my attached trading cards before this video ends. For my first scalping strategy, I'm looking at a breakout entry above $88. This is a momentum play that capitalizes on continued geopolitical headlines. The trigger is a strong break and close above $88 on the 4-hour chart. My entry would be at $88.10, with a stop loss at $87.30, just below the recent consolidation range. My first target is $88.50, which is the primary resistance level, and if momentum continues, I'll scale into a second target at $89.20. This gives us a risk-reward ratio of approximately 1 to 1.6 on the first target and 1 to 2.6 on the second. For my second scalping strategy, I'm looking for a retracement to the daily pivot. This is the buy-the-dip approach that assumes the geopolitical premium will hold. The trigger is a pullback to 86.40, which is our daily pivot point. Entry at 86.40, stop loss at 85.80. I'm keeping this tighter because it's a scalp. First target is 87.70, which gives us a quick 50-cent profit, and second target is 88.50. This strategy offers a risk-reward ratio of 1 to 1.3 on the first target and 1 to 2.5 on the second. For my swing trading strategy, I'm looking to build a position over multiple days. This is the trade for traders who have the patience to weather short-term volatility and capture the larger move. The trigger is a larger pullback to the 85 to 85.20 support zone. Entry at 85.10, stop loss at 83.20. This is a wider stop because we are dealing with a swing position, and we need room for volatility. First target is $90, and if momentum continues, I'll scale into a second target at 92.50. This gives us a risk-reward ratio of approximately 1 to 2.8 on the first target, and 1 to 3.9 on the second. Here's my honest perspective on these setups. I've been trading oil through geopolitical crises for over 2 decades, and the one thing I've learned is that these markets are unforgiving. When you're trading supply shocks, you need to respect the volatility and manage your risk accordingly. I'd personally scale into these positions rather than going all in at once, and I'd be watching the newsfeed like a hawk for any headline that could shift the narrative. Now let's talk about risk management. This is where most retail traders get it wrong. In a geopolitical market like this, volatility is your best friend and your worst enemy. The ATR14 of 2.45 tells us we can expect moves of roughly $2.50 per day, which means a typical intraday range of about 3% from the current price. If you're using excessive leverage, a $2 move against your position could wipe you out. Here's my personal approach to risk in geopolitical markets. I set my position size based on the assumption that any single headline could cause a 3 to 5% move in the opposite direction. I never risk more than 1 to 2% of my total account on any single trade, and I always use a stop loss. It's non-negotiable. I've seen too many traders blow up accounts trying to catch a falling knife or chase a rally without stop protection. This level reminds me of the Iraq invasion in 2003. Back then, the same liquidity grab fooled everyone who wasn't properly positioned. Don't let that happen to you. One final thought on risk management. When you're trading geopolitical events, the news cycle is your primary risk factor. A single headline from the US or Iran could send prices swinging 10% in either direction. Make sure you're monitoring the news in real time and have a plan for every scenario. I personally keep a list of potential headlines that would trigger a reversal, and I'm ready to act immediately if those headlines appear. Let me recap the key levels and scenarios you need to watch. For the bullish scenario to continue, we need to hold above the $85 support level and eventually break through $88.50 resistance. If we break above $88.50, the path to $90 becomes clear and we could accelerate higher. The news flow today from the EIA and API will be critical. If we see inventory draws, expect further upside acceleration. For the bearish scenario, a breakdown below $85 would signal that the geopolitical premium is eroding. If we break below 85, I would be looking for a test of $83.50 and potentially $80. In that scenario, the risk-reward would shift dramatically and I would be looking to adjust my positions accordingly. The key invalidation level is a daily close below $85. That's where I would reconsider my entire bullish thesis. Before I wrap up, I want to remind you of the bigger picture. This is not just about a single trade or a single session. This is about understanding how geopolitical risk creates opportunities in the energy markets. The Strait of Hormuz disruption is a structural issue that could take months to resolve, and in the meantime, every headline will move the market. By understanding the interplay between geopolitics, supply and demand, and technical levels, you can position yourself to profit from these moves while managing your risk effectively. I want to invite you to continue this conversation in the comment section below. What's your oil price target for Q4 2026? I've got my eye on $90 first, then $93, but the real question is, does this geopolitical premium hold or fade? Drop your levels below and let's discuss your perspective. This is the end of my analysis for Brent crude oil today. Remember to like and subscribe if you want to stay ahead of the market. I'll be doing a follow-up analysis on Friday covering the full week's action, and on Sunday I'll preview the week ahead with all key levels and setups. Stay tuned for those. They'll be critical as this situation continues to evolve. For now, trade safe, manage your risk, and remember that in the oil markets, the news is the ultimate driver of price. Until next time, this is Trade Meridian Decoded signing off.